All right, welcome to Today in DeFi. My name is Danger. I'm a DeFi trader, and today I'm with Michael Bentley from Euler Finance, not Euler Finance. And yeah, I'm really excited because Euler Finance is a really good team. Michael is a genius, and Euler Finance V1 and V2 have already been pretty awesome, but now they just introduced EulerSwap, which also sounds exciting. Yeah.
Thanks for a very, very kind introduction. Yeah, not sure about all of that, but yeah, no, I'm very happy to be here. Thank you.
Yeah, well deserved. I feel like there's a slowdown in like new DeFi primitives recently, so it's been great to see EulerSwap come out. Yeah. So I guess let's start off with introductions. So can you maybe tell me about yourself, your background, how you got into crypto or DeFi?
Yeah, sure. So I guess probably my first introduction was in 2015, and I started out as a bit of a skeptic. A friend of mine, we were finishing our PhDs and we were looking for what to do next and hacking away at stuff. And we were talking about building on something called Betfair and build, like hooking into their APIs. And he said to me back then, "Oh, why don't we build on this new thing called Ethereum?" And I was like, "That sounds like a really boring database type thing." I just totally underestimated what it was and really didn't understand it, I suppose. So yeah, I started out as a bit of a skeptic, but became more interested in 2017 after I'd finished all my studies and everything. And yeah, started hacking away, building fun things like running master nodes. That was like a big thing back in 2017. Like all these Bitcoin forks had these master nodes. So I was running a few of those and started running some on some of the early primitive DEXes like IDEX and Ether Delta. Started trying to understand market making, little market making bots and things. So yeah, I started really just sort of hacking away at stuff as a retail investor slash hacker. And then yeah, stuck with it. And 2019 things started to get quite interesting for me when I started to really understand the power of DeFi, I suppose. Didn't really understand Maker when it first emerged and why it was so powerful. But yeah, 2019, early 2020, we started to see Compound and Uniswap emerge. Something clicked for me. I was like, this is something special. And then later on, Yearn started gaining traction and all these other amazing, it was just this explosion of stuff in DeFi summer. So yeah, I got started with Euler essentially via a professional hackathon that I participated in. Met my co-founder, Doug, in that hackathon. He's a computer scientist by training. At that time, I was a research scientist. So my background's more in maths. I would say maths at the interface of computer science and biology was what I was doing in my day job. And together we built the first primitive version of Euler, a lending protocol. It was in a similar vein to Compound, but we had a bunch of innovations on top designed to reduce the governance overhead of interest rates and things. So that's how we got started. Summer 2020, raised the first seed round in September that year.
That's very cool. It sounds like you had an optimal background for building Euler. You got into crypto relatively early, and then math background, and because you're playing around with DeFi early, I guess you also have some exposure to financial primitives or financial concepts and stuff, like if you're running a market making bot or something. So that's
Well,
awesome.
my skill set is kind of jack of all trades, to be honest. Like, I wouldn't describe myself as a mathematician, but I'm also not a computer scientist. And to the extent I did do some lab biology as well, I wasn't very good at that either. But what I tend to be good at is being able to integrate different branches together. So a lot of my day job was, I guess, like evolutionary game theory, sort of building models of dynamic biological systems, either using mathematical modeling or computational modeling techniques and thinking about strategic interactions among players in games, basically. So thinking about like mutant bacteria against wild type bacteria, where the mutant maybe has some advantage of some sort, like maybe resistance to an antibiotic. So I think, how does a mutant take over a population? So yeah, I was very adept at thinking about strategies, and DeFi is nothing if not just people playing strategies in very complex games. So it doesn't sound that similar, evolutionary game theory and DeFi, but actually there's huge overlaps in terms of basic concepts. And the maths in both is kind of quite simple in some respects. The strategies that people play tend to be quite simple, but they're obviously optimized for profit in one case and for survival and reproduction in the other case.
Very cool. Yeah, I definitely noticed that a lot of successful DeFi builders and even traders or users have somewhat of a mixed skill set. I think you having that math background is super useful as well, especially for building something like Euler. Well, let's get into Euler V1. So we're already on EulerSwap, which is even past Euler V2, or it's part of Euler V2. But even Euler V1, which came out in, I think, the end of 2021, was quite special. I think it was quite forward-looking at the time. So it pioneered some stuff like permissionless markets. I think even isolated markets, one of the first lending markets to do that. And also you guys had built-in leverage strategies, like these built-in zaps and stuff. And that I think is starting to happen a bit. But even today in 2025, you don't really see that very much. And for pro users and stuff, that was quite cool. So could you tell us a bit more about V1, what was special about it, and how it worked and stuff like that?
Yeah, so if we look back in time, Compound was certainly the biggest money market back then, bigger than Aave even. But both Compound and Aave had similar structure where they were both kind of monoliths with single money market sort of design with lots of assets within that single monolith, I suppose. And we wanted to see how can we break into this market? What could we offer that's different? And we thought being able to offer money markets, lending and borrowing facilities for all sorts of different kinds of assets might be a way to break into the market. So we wanted to address the long tail, I guess, to some degree. And so, yeah, we recognize that obviously these long assets are much riskier than other assets. And so we had a primitive version of sort of isolated markets, I would say, as you pointed out. So, one collateral, one asset that you're borrowing, try to restrict the kind of damage that asset could do within a market. And yeah, on top of that, we had a whole bunch of really nice innovations, I think, that persist through to Euler V2, and as you said, market-leading, UX improvements. One of them is this ability to essentially multiply your exposure in a single click. In the good old days, I remember when I first started playing around on Compound, and what people would do is they'd deposit one asset, borrow another, and then they'd swap it on a DEX, and then they'd come back and deposit, and then they'd borrow, and they'd swap. And you would see people building up these essentially long positions, and it would cost a fortune. They'd spend hundreds of dollars, and it would take 6 hours or whatever to set up a 5x exposure position, because you have to do maybe 10 or 15 loops of this painful thing. Like this, there has to be a better way here. So essentially, we realized that you can kind of follow if you sort of do the maths for this, there's like an infinite sum basically that you can solve. It turns out it's like a solvable infinite sum, so because it converges. And then what you can do is, rather than let people loop manually, you just let them type in a number and say, no, I want 5x exposure. And then you can reduce this down to essentially a single deposit, a single borrow, and a single swap, where rather than doing the looping to get to some state, you just jump right to the end state. And so, yeah, it provided a much nicer way, I think, for people to be able to amplify their exposures to, whether it was to yield or to directional price exposures. So, yeah, it was very popular and people really liked the UX of Euler. We were able to take quite a bit of market share.
I just want to say the UX was amazing, because all this stuff that you're talking about, you're right. Like, people were doing that manually. And like during DeFi summer, like before Denkun and everything, the gas prices were crazy. So very expensive. Yeah. And also just a pain in the ass to do that stuff. So you guys building a tool to actually do all those actions was quite incredible. Like, me seeing that, I was quite impressed. I mean, even today, you don't have, like, lending markets don't really do that. I still haven't seen that on anything except Euler. So yeah, really good job.
There are a few offering similar now, but people tend to do it with flash loans still and other things which can cost money. And it's something that the professionals quickly realized that you could do, but they had to build custom solutions for it, typically involving flash, sometimes involving other third-party exchanges and so on. In Euler, it's all fully integrated. And, if we look forward to V2 now, I would say it's even more powerful because we have an internal swap router that handles a lot of the different swap routes and things for you as well. Back then, it was essentially just hooked into EulerSwap, and these days it's optimized for the best possible swaps that you can get. So when you're doing these multiply trades, you can do it with Pendle tokens or things with PSMs. You can do it with all sorts of weird and wonderful assets. It's heavily optimized.
The other part that I'm impressed with for Euler is that DeFi has a lot of composability, and that's great. But you guys are actually able to do a lot of low-level stuff as well. Your UX is great, and then also at the low level, you're innovating. Like you just said, you guys are kind of vertically integrated there with the swap. And that's quite impressive. It really makes me feel like I should have studied math harder in school. I remember taking calculus in university, just thinking, when am I ever going to use this? And then come out, and I'm like, wow, I really should have paid attention in calculus. So if your math is good, as a trader, as a builder, it's like a competitive advantage here.
You know what? The good old quadratic equation came up when we were trying to provide quotes in EulerSwap. You have to solve the quadratic equation. People always ask, when am I ever going to use this? Granted, most people will never use it ever again, but for me, this is great. I'm probably like 30 years on from when I first learned this, and here I am using it for an actual product. It's pretty cool.
Every time I look at AMEP's research, I'm always like, oh man, I should have paid attention in math class. Yeah. So we're on Euler V2 now, and in between Euler V1 and V2, there's an unfortunate hack, but this is in 2022. And at the time, most DeFi hacks were just like silly, like people were not paying attention. They had bad code, they weren't doing their audits, they just were pushing to production. But Euler's hack was quite different. I was actually very, very surprised it was hacked. I think most of my friends were, because you guys had done a lot of audits, you guys had done basically all the best practices possible. So could you walk me through a little bit about the hack? I feel like it was a little bit of bad luck as much as it was anything else.
Yeah, I mean, ultimately, it's a very difficult industry to build in. Things have improved a lot over time. The resources and tooling have improved. The knowledge base of the dev teams and the auditors and everything have improved a lot as well. So things are certainly getting better. I feel they are anyway. But a lot of lending protocols, even big ones like Compound, they've all had critical vulnerabilities discovered in production at some point. So it's not unique phenomenon to Euler. But what was unique is that ours was discovered by a black hat who decided to exploit things rather than take our bug bounty. We actually had the largest bug bounty of any lending at the time. At some point later, when I ended up negotiating with the guy, I asked him, why did you not just take the bug bounty? And he told me he wanted to do it because he wanted to be famous. That was his motivation. He wanted to be, rather than famous, infamous. So he kind of grew up admiring hackers and he wanted to be a famous hacker. So yeah, that was very frustrating to hear. But anyway, yeah, how did it happen? Well, when we built the protocol, obviously it was heavily audited and it went into production. And shortly after going into production, we got an Immunify bug bounty came in and we looked at it and said, I think this is legit. The bug bounty said that we had this much smaller bug, which said that essentially somebody who was very first using the pool could have the very first deposit only could be front run in the pool, and that's because there was some exchange rate essentially between some of the tokens, internal tokens to the system that wasn't initialized, and so without an exchange rate, essentially it allowed an attacker to kind of set the exchange rate in a way to allow them to profit. So because there was a loss of funds here, sort of medium-high vulnerability, I would say. Certainly not a full-on critical, but regarded as a serious bug if a loss of funds can occur. So we discussed it with our security partners and they said, yeah, this probably warrants an upgrade to the protocol. So we upgraded the protocol with a fix that we figured out. We had the fix itself audited. What we decided to do is we said, well, if there's no exchange rate initialized, why don't we take the user's first deposit and make them initialize it themselves? They can do that by essentially just depositing a very tiny fraction of their funds into the pool as a deposit to initialize the exchange rate, and from there there'll be no loss of funds possible because the exchange rate will be initialized. Anyway, we called this function donate to reserves and it went into production, seemingly closed off this issue. Unfortunately, fast forward another 9 months, somebody figured out a way to use the donate to reserves function in a much more malicious fashion. Essentially, they would donate their own money to the protocol, some of their accounts to go unhealthy, and then they figured out that they could make a small amount of profit by liquidating themselves profitably using a separate account. And so with one account, they'd be losing money, and in the other account, they'd be making a tiny bit more than they were losing. And if you loop that up, you can essentially, they figured out that you could withdraw all the funds in the protocol eventually. And so, yeah, that's ultimately what happened. Around 200 million was stolen initially, and we recovered all of the funds. In fact, we recovered 240 million. Bizarrely, because during the several weeks that it took to recover the price of ETH rallied. I mean, he did what a lot of attackers do, which is that they convert the assets to ETH, right? And ETH rallied during that period. And so when we returned the funds, we returned more than was taken in dollar terms at least. So it was a very unusual set of events and not a good time for us, but thankfully in the past now.
Yeah, it's great that you guys were able to recover the funds and more than the funds because of the price of ETH rally. But yeah, that is really like, I don't know. I feel like just not. I'm glad you guys are back because you guys really deserve it. Because that was just a really unfortunate situation. Like you guys did everything right. You had the best practices, like the industry-leading practices, and then like following a bug bounty get you hacked is so bad. But then you guys were able to recover everything, so that's amazing. And now you're back.
Really, it was a really unfortunate time. I mean, as I say, I think a lot of things have improved since then. The audits, the first small bug was missed by a lot of the auditors, but that's now quite a well-known type of bug. I would say the first deposit issue, that is quite a well-known thing that a lot of auditors would just look for now. It came up in a bunch of other protocols as well, not just Euler. And so it's one of those where the dev teams and the audit teams become more experienced. The tooling as well, with V2, we have much more powerful tooling in terms of fuzz testing and formal verification. Back in V1, we were on some of the earliest formal verification. We were trying to lead the way on that kind of stuff as well. But it was just the tooling and the knowledge just wasn't there. So it was unfortunate, a very difficult process for learning about all these new types of issues that can affect protocols.
The security landscape was definitely more primitive. The auditors were less experienced back then. And then you guys took a long time to roll out V2. And I was actually happy about that because the way you guys, I think, finalized the code or the design really early on, like 2023 or something. But then it took over a year for Euler V2 to come out, which it might be bad, but it's because you guys did a ridiculous amount of audits. I was like, oh, they got 4 audits. Okay, that should be good, right? It was like 10 audits. I was like, wow, I've never seen so many audits. And then there's more audits. So yeah, could you tell me about the process, the security efforts that you guys went through? I heard you guys used Huff or something, and some things were formally verified.
Yeah, I don't know about Huff, but I'll tell you through the process. I mean, one thing we decided very early on was we wanted to build modules and not try and build a more complex kind of monolithic product. We wanted to build using a modular stack where you just build one module that does one thing as well as it possibly can, and then you can independently audit and secure that one module, knowing that for all the types of inputs it should face and all the types of outputs it should face, have a really well-defined interface for this particular module. And the idea was that would make auditing and testing of the module much easier. And then later on, you can then compose these modules back together to build the products that you want. Then you need to have the products audited, right? And then the way that you compose the modules together. So it's definitely a much slower and more time-consuming and expensive way to build a product. I would say that was a very early design decision. We also brought in security researchers really early into the process and talked to them about our early design. So we didn't just build something and then ship it to audit at the end. We invited some of the best security researchers to come in-house and check our processes and get involved in the design phase, the very early proof of concept building phase, to highlight areas which might be particularly challenging to work on. And then through the process, we had bespoke testing and formal verification libraries built for us, worked with other teams to build those. Sato formal verification and Enigma Dark on the testing libraries. And aside from just writing unit tests and things, these two approaches are really useful, I would say, for catching really horrible edge cases and things that your tests can't catch. Thought testing is a very powerful way to just essentially blast your code base with a bunch of randomness and see, okay, given all these random inputs, do any of these outputs at the other side look like something that shouldn't happen? If you define something in your system like your health score should never drop below 1 if you don't take certain actions, you then want to know, are there any circumstances in which that might happen? Well, you write tests for that, but the tests are very difficult to capture all possible circumstances. So one way is to just blast it with randomness and just chuck in a whole random numbers and see, do you ever get a variant broken at the other side? So that's fuzz testing, and we use that on the Euler kit. The form of verification essentially tries to do something similar, but it tries to solve equations. It essentially turns your code into like a system of linear equations. Then it's like, can we solve it and formally prove that there are no solutions where the health score goes negative under certain assumptions? They're both really powerful techniques. Both have trade-offs. One of the things we try to do with the security and audits is acknowledge the different trade-offs of the different ways you can secure code, and then try to make sure that we're covering any holes that any one approach has. And that's also partly where we had so many audits, was we wanted to use different types of auditors and different types of audit process. So we did both like conventional audits with professional teams, with some of the leading companies in the industry, but also did a contest where we invited people from all walks of life and all backgrounds to come and try and attack the code as well. And then we also did a capture the flag competition where we put our funds into the protocol and said, it's legal. If you want to come and take it, you can take these funds now. So we tried to do everything we could to lock down the code base, I think. And yeah, it was a very, very comprehensive process.
Formal verification, I think, is like, that's like the most hardcore thing you can do. It's like formally proving that your code is secure. Yeah,
it definitely has limitations. I mean, I think sometimes it's a little bit overhyped on social media because to be able to formally prove something, you have to first give it assumptions, right? So if your assumptions are bad, then you'll have formally proven something, but what will it really be everything you want to prove? It's a very powerful tool when you use it correctly, but it's hard to use correctly, I would say. It's something we were very keen to do, but we would never say that it's the only solution or the best way to do things. It has its own trade-offs associated with it.
Got it. So based on what you're saying, it almost sounds like the fuzz testing is a really good complement to that.
Yeah,
it's
giving totally complementary. Yeah. I would always say they're complementary. Because the thing is, if you have things like that are non-linear in your code, then formal verification struggles to do proofs, and so you have to then kind of break the non-linear system down into something into like linear fragments, and then try and prove each like linear fragment. Fuzz testing is great because you never prove anything with fuzz testing. It's like, it's just random numbers, right? So you can never formally prove something. You can only just get empirical evidence growing over time that the more numbers you test it with, the more you can be confident that an invariant can't be broken, but you've never proven it. So yeah, one is proof, but it's limited proof, and the other one is not proof, but it covers a wider scope of all sorts of systems, whether it's non-linear or linear stuff involved. It covers everything.
Very cool.
So yeah, very complementary in my opinion.
Yeah, it's cool. I feel like you guys have almost like are like pioneering like new security practices and stuff, like bringing in researchers in your development process and stuff. Like, yeah, it's a shame you guys are a DeFi protocol, because I feel like you guys could almost be like security consultants or advisors or something at this point. Like, you guys should give talks at security conferences. Yeah, but bringing it back to DeFi, yeah, can we talk about like so yeah, V2 super secure, you guys, yeah, that's amazing. But I mean, it's also like an amazing protocol. Can you tell me about V2? I know you guys improved on iterated on the transaction batching and isolating markets. Can you tell me about some of the differences between V2 and V1, and what are some of the benefits of Euler V2?
Yeah, I mean, aside from the things you mentioned, I think because it's this modular protocol, it's so much more powerful in terms of the types of products that you can build on the other side. So when we built V1, one of the things we acknowledged that was limited about it was that it was one big product basically, and there were lots of users that would come to Euler and be like, "Can I build this? Can I build that?" And the answer would sometimes be yes, but often it would be no. And you get other types of users, less on the building side, but just on the on the side of lending and borrowing, and be like, I don't really like the setup of this. It seems a little too high risk for me, or I want to earn more yield. I'm asking for more risk. Can you provide that? And so that we didn't have. It was kind of a one size fits all, and you either liked it or you didn't. And then if you didn't like it, you maybe go to a different lending protocols and so on. That's kind of still the same for certain protocols today, right? Like Aave is a little bit like this. Aave doesn't claim to be everything, but it claims to be a product that captures the mass market. And then on the fringes, if you don't like Aave, then use something else. V2 allows people to come in and build their own products using the modules. So it's more of from a builder's perspective or product design perspective, it's more of a kit. It's a developer's kit where you can come in and you can recreate monolithic markets like Aave, or you can create isolated pairs, a bit more like Morpho, or you can build anything in between, or entirely new classes of products. So it's an incredibly flexible builder's kit. It uses these things called vaults under the hood. Vaults are just assets that they're like essentially items that hold assets that can either be used as collateral or it could be used for lending and borrowing. And by combining vaults into different combinations and different designs, you can make very, very different types of products tailored to very low risk types of markets, focusing on maybe real world assets, all the way through to isolated markets and things that maybe cater more to high risk seeking type, long tail stuff, all the way through to more capital efficient markets like Aave. So there's just all sorts of different types of products you can build. And people have built lots of different types of products with V2. So it's very much not one size fits all protocol, and there are other powerful features in there as well. There are hooks that allow you to essentially modify the way that vaults work. They can allow you to add extra security features, access controls, allow you to add like compliance checks, permissioning, handle things like permission liquidations, or deal with some of the weird and wonderful new types of assets that are increasingly coming on chain from traditional finance as well.
Very cool. Those designs have been very successful. You guys have grown tremendously. I think you guys are over $1 billion now. And looking at the markets you guys are supporting growth, I think a lot of it has been through supporting new assets. You guys have been very agile in listing new assets, getting onto new chains. So, new yield-bearing stables and staking tokens. Yeah, so great to see that growth.
Yeah, I mean, definitely does cater to all different asset types, and I think that's been partly the path to adoption of Euler, is to be able to cater to assets that other incumbents maybe don't cater to as well. And as you mentioned, the curators themselves, the nice thing about Euler is that There are so many assets out there, and we don't know about all of them. We don't necessarily know how they all work and all the details. We're not connected to the communities or even the development teams behind them, but the curators often are, and so they come with their own networks, they come with their own predefined user bases, and they're able to build things for other people that cater to their needs. And I think that allows Euler to grow a lot faster because we're not constrained by our knowledge base, the people that we know, and so on. Essentially, we depend on other people to go out and expand and distribute the technology to the wider market.
And that's been a really good approach. Like whenever I log on to Euler, I always see great opportunities on PTs and just all kinds of assets. And now we have EulerSwap. Can you tell me a bit about what that is, how it works?
Yeah, so it's a new swapping protocol and it's built on top of Euler. The reason it's built on top of Euler is because integrating a swapping and lending protocol together very tightly massively improves the efficiency of both, arguably. One of the big problems with traditional protocols is you have people called liquidity providers, LPs, that bring in assets into the DEX and they basically make the order book for the DEX. And they make markets. People can then swap against their liquidity. The problem with that is that a lot of the time swaps aren't happening every block, or even if they are, they're very low volume swaps. And so you essentially have this enormous cost of capital for being a liquidity provider on a DEX. It just doesn't work like that in TradFi. In TradFi, when you're trading against an order book, it isn't like the assets are literally sat there. It's just an accounting scheme for assets that are actually held elsewhere and often earning their own yield at a bank or whatever, and they're passively earning yield from other sources. And essentially then you settle up at the end of the day or settle up at some point periodically and provide people with the outputs of the swaps that they're getting. It's just way more efficient, I think, from a capital efficiency standpoint to do it like that. So on EulerSwap, by default, the assets sit in Euler's vault, which means they can be earning a yield if that's desirable. It's not enforced, but they can be earning additional yield from lending and borrowing. So that means between swaps, where there's no swaps on a particular block, you're still earning lending yield as an LP, even if there's no swaps. So you earn both lending yield and swap yield essentially as an LP on Euler, which makes LPing much easier because it's well known that LPing can actually be costly. There's all sorts of costs associated and risks that you have to take. So if you can make it more profitable for people and provide additional sources of yield, you can make it much easier. That's one problem that we solve. The other problem is that ever since I first started getting into DeFi, people would ask, oh, can I use my LP tokens on Uniswap or Curve as collateral in a lending protocol? Now, why do you want to do that? You want to do it probably because you want to borrow against your LP position so that you can either hedge the risks of the LP position. If you've got $1 million LP'd, if you can borrow $900,000, then you essentially hedged at that point. In the worst case scenario in which your LP goes to zero, you keep the $900,000 and you essentially passed on the risk to the lenders, right? So you want to be able to borrow against your LP tokens so that you can hedge and pass risk on to other people. And obviously that's not free. You're paying the lenders to take on board that risk by paying them an interest rate. The other thing you want to do is potentially leverage your LP position. This is something projects themselves often want to do. They put $1 million of liquidity in. Well, if they can do that trade we talked about earlier where they borrow $900,000, then redeposit that back into liquidity, borrow some more leverage. If they can do those loops very effectively, then they can actually amplify the amount of liquidity they provide for that project. And this is one of the big key stumbling blocks, I think, for a lot of projects when they first get started, is it's very costly to provide deep liquidity. But it's a chicken and egg. If you don't have deep liquidity, it's very hard for your project to do well. So you need to pay for that deep liquidity somehow. And people are just desperate out there to try and find ways to amplify the liquidity that they provide. And there's just no great solutions out there today. EulerSwap allows you, because the liquidity is held inside Euler vaults, when you provide liquidity, that borrowing functionality comes by default as part of the process of being an LP in the platform. So if the liquidity you're providing are in vaults that are also accepted collateral by some other vault, you can just borrow against that LP position natively within the platform. And because we have powerful batching technology and order routers and all the rest of it, you can essentially either hedge the position in a single click, or you can multiply the position and amplify the liquidity in a single click, just like you can do when you're a trader on Euler. So for the massive advantages for LPs on Euler in terms of being able to earn additional sources of yield from lending and then to be able to borrow against your LP tokens.
Very cool. It's like an enhanced toolkit for LPing with the lending protocol. Yeah, that's really cool stuff. Would that be possible?
So what you can do, I mean, IL is kind of intrinsic to anything in DeFi as a whole and to the way that DEXes work. So you can't necessarily ever remove impermanent loss. I wouldn't say there are various techniques you can use to try to reduce its impact. And certainly there are a few of those available on EulerSwap. A classic way to LP, for example, is professional market makers do this. They'll deposit some USDC. They'll then borrow ETH, and then they will LP with USDC and the borrowed ETH that they've just acquired. And the reason that they do this is because, when they very first LP, they have on the one hand, let's say they do $1 million position, they'll have $500,000 borrowed, but they'll also have $500,000 worth of in the LP token. So they're neutral to begin with, right? If it goes up in price, in principle, it doesn't matter. Of course, when you're facilitating the LP, though, if ETH goes up in price, that means the amount of ETH you hold in the LP is going to go down. People are going to take ETH out of the pool and put it in. So you'll constantly be then slightly exposed directionally to ETH, much less so than if you just put USDC and raw ETH in to begin with, because then you would be very exposed. So you're less exposed by borrowing the ETH, but still exposed. And essentially what the market makers do periodically is they'll try to rebalance when it's cost effective to do so. So what they're trying to do is rebalance the hedge by essentially making sure that the amount of ETH in the LP matches the amount of ETH that they borrowed. And the best way to do this would be to do it every single swap, right? Just make sure that you're perfectly matched. And in theory, if you could do this, you would massively cut down impermanent loss and other costs. But rebalancing is very costly, right? It's not free to rebalance. You have to do swaps yourself. You have to potentially repay loans and so on. What EulerSwap does is it provides people a way to effectively build hedge positions and rebalance much more cost effectively, which again lowers the cost of LPing. So one thing we have, which is a novel primitive, is called just-in-time liquidity. Let me try and explain it very briefly. Essentially, what happens with just-in-time liquidity is when you swap something in, rather than having liquidity ready-made to be passed to the user and swapping it out, what we do is we take your swap input amount and we use it as collateral to borrow just in time the amount that we're about to send you. What that means is, in the context of that hedging strategy, is that effectively, rather than borrowing $500,000 worth of ETH up front and then putting that into the LP token, we borrow $0 up front. We enable swaps to happen on borrowed liquidity. Now, what happens then is if your swap comes in, we would effectively just borrowing only what we need just in time, then LP it, and then sending it out as the swap output amount. So we're avoiding the need to set up a large borrow position initially and only borrowing what we need just in time. That massively reduces the costs of these rebalancing strategies, which can potentially make it much more cost effective to LP, again, even when they're a volatile pair. One final thing to say about just-in-time liquidity is it's extremely powerful when you have two correlated assets. There you can massively amplify the amount of effective liquidity that you're providing by using this borrowing facility. If you have, let's say, again, we'll start with $1 million position. If we take two correlated assets, let's use USDC and USDT as the example. Now, because they're very correlated, they have high loan to value parameters, which means you can use USDC to borrow a large amount of USDT and vice versa. In an extreme case, that means I could, if I wanted, go 20x long USDC by borrowing $19 million worth of USDT and turning it into USDC as collateral. Alternatively, I could do the opposite way. I could go long USDT against USDC. Turns out with the parameters on Euler today, you could actually go 20x long one way or 20x long the other way. What this means for the LP is that you could actually facilitate swaps using $1 million worth of margin collateral that provide the same depth as a 40 million USDC, USDT pool on Curve or Uniswap. So you essentially have simulated the amount of liquidity that you can access. Like you borrow it just in time to provide liquidity. What that means is if you wanted to make a 40 million deep pool, you don't need to use $40 million anymore. You use $1 million and use just-in-time liquidity and take the 39 other $1 million and put them in some other yield-bearing strategy that's lower risk perhaps. So yeah, just-in-time liquidity is a new primitive that's very powerful for increasing the depth of liquidity, but also helping people that have these volatile strategies rebalance more cost effectively.
Yeah, actually, you answered some questions that I was going to ask about the just-in-time liquidity, which I think is a really good term. And yeah, I wanted to ask, so that basically means, I think that's actually good for both the LPs and also the swappers. So I guess the LPs, does that mean that they could like essentially like if they're LPing something, they could, because they can kind of simulate a larger liquidity position, does that mean they can get more trading fees? And then on the converse, I guess like not really a question, but like for this, it's an obvious advantage because they're getting a much more liquid pool than the spot liquidity.
Yeah, that's right. I think on the swap side, you don't know any different. You have no idea that you're using just liquidity. With just-in-time liquidity, sometimes when you start to go back the other way, what you end up doing is you end up repaying, rather than building debt, you end up sort of repaying debt and then taking out collateral. But for the swapper, you don't need to know this, right? You don't know the internal mechanics of how the swap works. All you need to know is, am I getting a good rate? And certainly the ability to provide deeper liquidity means that you potentially can get a better rate, I would say. On the LP side, I would say, yeah, the main thing is just capital efficiency and flexibility. If you're a new project, you can potentially provide deeper liquidity at a cheaper rate than you would normally do. I still think there's a bit of a confusion in DeFi that LPing should be something that is very profitable. In practice, it's often not. People who make markets often get paid to make markets, and it's not because they're earning so much in swap fees that they're profitable that way. So new projects often pay professional market makers to make markets for them, and it's often very, very costly. It can cost 20% APY a year. It's a very, very costly process. And what we're attempting to do here is to lower the costs so that people can provide deeper liquidity more efficiently than they otherwise would.
A lot of the stuff you're talking about kind of reminds me of what I hear about prime brokers and stuff. So it seems like there's going to be potential for a lot of really cool new products to be built on EulerSwap. You highlighted some of the use cases. I think you guys are having a builder competition right now, so that should probably bring to life some more cool stuff.
Yeah, we've already found, before the competition is not live yet, we're going to be working with another partner to bring the competition to life soon. And then before that's even started, we've had some inbound requests from some great builders in DeFi already to build some pretty cool new products. In fact, my next call is with a team who are looking to build something very cool. It uses EulerSwap in fixed rate lending protocols and other things. And yeah, we had some inbound about people building novel strategies and tokenized strategies, and there's even plans for using EulerSwap for order books and things in the future. So this is just the absolute base protocol right now. I think there's a huge amount more to come in the next few months.
Very cool. And what should builders or market makers and other people who are interested in using EulerSwap or checking it out do? Where can they go? Should they be participating in this competition?
Yeah, definitely very welcome to do that. We're trying to put together the competition in conjunction with a team called Encode, who run professional hackathons. So very welcome to participate in whatever we put together with the Encode team to help with the competition. Visit Euler Finance on Twitter/X at Euler Finance, and then you can follow me. I'm at Euler_MAB. That's my initials at the end. Pop into our Discord as well. We're very active in there and love it when builders come in and start asking questions. We've got a channel in there for minded people as well as general channels for more generic questions. Or if you're a project that wants to host a pool on EulerSwap, we've already had a lot of inbound requests from new stablecoin projects, and DAO's protocol and liquidity have been reaching out, wanting to figure out how to create more efficient pools with protocol and liquidity. So yeah, pop into Discord, drop me a message on socials, on Twitter, and we'll figure out a way to connect and get people building.
Very cool. Thanks so much, Michael from Euler Finance. Check it out. I believe it's Euler Finance. And yeah, thanks for tuning in, and see you next time.